All right, very good. Okay, excellent. Thank you for coming into the webinar. Sorry I'm a little bit late. The subject of today's webinar is basically trades for 2014, the big thematic trades that are going to be developing in 2014. And I'm going to start with some of my own ideas, then I'm welcome to any questions you guys may have on your own pairs, and we can just have a free, open discussion of what's going on, okay? So I think, the first thing that kind of interests everybody is, where's the dollar going? And to me, the more interesting chart is going to be the dollar-yen chart. I'm going to go to a much longer time frame, obviously. Let's go to the weekly chart, because I think the weekly chart tells us a lot about where the potentials are for 2014. The common view, I think the most consensus-driven view, is that it's a pro-dollar year, U.S. economy continues to grow, QE becomes less and less available. Notice we're now in the QE removal phase, where every single month we're going to remove more and more liquidity from the market. And if the U.S. economy continues to grow at a 2.5% to 3% rate, that potentially means that interest rates will begin to lift off of the zero interest rate cycle. So that's the consensus view. And the consensus view basically then argues, and let me just go on a longer term chart here, that the trade in dollar-yen is a trade all the way to 110, right? And that, I think if you have the fundamentals line up that way, in other words, we start printing 200,000 NFTs, we start doing very well in 2014. It's a reasonable assumption that you're going to have dollar-yen break through this 105.50 level and establish a fresh zone at 105.110. And the potential really for on a longer-term chart, if we go into the monthlies all the way out to like 5 years, right? You can really see that on a 5-year basis. Actually, I think we have to go to 10-year. You can really see on a 10-year basis how this 105 is a very, very key resistance level, right? Tremendous amount of overhead supply over here. But this 105, 110 was the last time we were there was pre-2008, actually post-2008 credit crunch, just sort of a bounce back on a 2008 credit crunch before we finally collapsed completely. And dollar-yen then just went to a 75 low before it finally bottomed out. So for us to come back here, that would be a significant comeback. But even if we come back to the 105, 110, the really true breakout, the really, really strong pro-dollar trade would be a move above 110. It's only when we clear 110 on a very long-term basis that we have really no overhead resistance to 125 until we have the days of the carry trade. And in fact, I really don't think you can reasonably expect us to see 110 or above until and unless the market begins to price in the possibility of U.S. rate hikes. That may be middle of this year. That may be third quarter of this year, depending on how well the economy does. But it's only when the dollar becomes a carry trade again, where its interest rate actually begins to pay something against the yen, that you could potentially envision the possibility of 110, 115 in the market, right? For now, though, the really, really interesting story, the much more immediate story is 105 or 100. I'm actually kind of curious. What does everybody think? Type in whether you think it's going to be 100 or 105 first before in dollar-yen. So Mike thinks 105. Anybody else have an opinion? Milan and Pan go to 100. Nick is 105. So far, it's a pretty split market. It's a pretty even market. Vishay is saying 100. And I think, what's interesting is that the view, Ramesh is at 105. The view in the room is very indicative of the view in the market. We're at a point of a pretty serious equilibrium here between the bulls and the bears. It's not quite clear that the bulls have lost, but it's certainly not clear at all that the bulls have won. I mean, Friday's non-farm payrolls, even though it was a single data point, was certainly not a pleasant data point for the market to consider. And all of the reporting from the Christmas sales in the U.S. shows that the consumer, while relatively okay, has not been extraordinarily strong. I'm sorry, hang on, guys, a second. I just want to say that. Hang on. Boris Schlossberg. Yeah, hello, Boris Schlossberg. Is this? Okay. So Dustin has Dusty has a much more aggressive point of view. He says that the correction is already in progress, and if we don't close above 103 today, which is the 50 SMA on the dailies, then we go to 100. Maybe, I do think that if I'm going to be making bets here, and I also don't have a crystal ball, but I think the call for a correction may be quite strong. We could get a surprise in the retail sales. We could get a bump back up. But I think this 105.50 is a very, very chunky area of resistance here. And it's going to take some unambiguously positive U.S. data for us to push through. So if we get more negative data this week, I think it's easy to see us drifting towards the 100. But then having reached the 100, I do think that this is pretty serious support. At this point, then it becomes a story of really deteriorating U.S. fundamentals. In other words, yes, we can have a correction. In other words, a pause in growth, but still positive growth in Q01. And that will keep us at around 100. But if we have literally the threat of a potential contraction, the stock market starting to really sell off and having a 10, maybe a 12% correction to the downside, that kind of a dynamic definitely takes us well below 100, could possibly take us all the way out to 95, which, of course, is completely not the consensus view. This is certainly not where the market is at. The market is much more skewed to the upside. So that would actually, exacerbate the move because so many people are positioned long that if we did have a severe sell-off to the downside, that would suggest, a quick move from the 100 all the way out to 95, which I think is really, really steep support here for the move. So while the longer-term view still remains modestly optimistic, and the prospect of 105, 110 range, I think, assuming the situation in the U.S. does not get worse, is very possible as the year goes by. Because if the situation in the U.S. does not get worse, and we continue to kind of hover around these levels, the natural dynamic of the monetary policy, where the Fed takes more and more accommodation off the table, and the market begins to prepare itself more and more towards an interest rate hike, will drive us forward. But if we get to we actually start to see month-on-month declines in growth, and everybody wringing their hands, and the market selling off 10%, and the Fed seeing pressure on perhaps stopping QE taper. That is, the Fed just simply not continuing to buy bonds at a pace that they were buying. That would be all very, very negative. Abenomics not having much of an impact. I think at this point, Abe has done everything he can, or at least everything that he is willing to do, to drive the yen higher. They're not going to really expand their QE monetary policy any further than they already have. They've committed about as much capital to this idea, I think, as they want, and they're basically waiting for U.S. to pull them out. They're basically waiting for U.S. economy to kind of be the locomotive for the global economy, and that will naturally, of course, lift dollar yen higher through lifting U.S. rates higher, and that will naturally help the Japanese economy because it will make interest rate differentials even that much better. Okay. So, that's dollar yen. Let's take a look at euro dollar. Now, euro, I think, surprised a tremendous amount of you. This, by the way, is a monthly chart, so interesting thing from a monthly chart, this is when you're looking at a very, very long point of view, is that we're kind of just building this massive symmetrical triangle, right? The volatility continues to compress and compress and compress here. And usually when you get these kind of formations where you have continuing volatility compression, you have a volatility burst one way or the other. So when you're looking at this from a longer perspective here, it's either a burst to 140, again, a very out of consensus view, or a decline below 135, which I think is much more where the market thinks the euro dollar will go long term, because there is a massive differential in monetary policies right now, right? The European monetary policy is a lot more accommodative, and the U.S. monetary policy is a lot tighter. So the natural move here for the euro dollar is 135 or below. But having said this, the key thing that you want to look at when you're looking at this stuff is you have a thesis, but you don't have a price. If you don't have a price, your thesis is not worth anything. So we can all wish for the euro to weaken, but until and unless it does, is no way clear that this is going to be a weak euro year so far. All we can say is that we may be coming to the point of resolution. But the point of resolution is really going to be the 140, 135 break one way or the other. Now, if we do come down and break the 35s, of course, on a very short-term basis, on a daily basis, we can see this. There is support. There's basically support underneath 35 over here, all the way down to 34, and there's, additional support at 33. So basically every 100 points there's support. But then after that, if the euro breaks, it really, I think, has a very reasonable chance to come back to revisit 130. So if we have an unambiguously strong dollar story where the dollar begins to pick up pace, and more importantly, I think 2014, more than any other time in 5 years, and this makes a lot of sense actually if you think about this. What's been the story for the last 5 years? The story for the last 5 years has been that there's been no rates anywhere except Australia, right? You haven't been able to get rates anywhere. The interest rate everywhere has been effectively 1 or 0, right? So if this is the year of recovery, if this is indeed the year of rates going back up, this is going to become very much that story, the story of rates recovery. Now, one of the interesting things, the reason I bring that up is because when you look at the euro, the surprising reason for why the euro has been so strong has been the story of rates, but not in the way you would think. It's not that European rates have been rising. They've actually been falling. But the irony of the whole thing is that Europe, especially when it comes to periphery bonds like Spain and Italy, is one of the last bastions for yield, right? Spain and Italy were at 5% yield. So the rally in the euro has been, at the beginning of this year, pretty much a chase of European periphery rates as everybody realized that, okay, sovereign debt risk in Europe pretty much off the table, and actually Spain and Italy can withstand 3% yield and be considered to be a valid sovereign risk at that yield. And so that's been the driver for European strength. Now that cycle could reverse itself if you get this situation where U.S. rates begin to rise, because obviously the U.S. is a much better credit than Italy or Spain. And if U.S. 3 years begin to go to 3.5%, then they're going to provide a very strong competitive product to European bonds. And that could be the reason why the euro, even if, let's say, the irony of the whole thing, even if the global economy starts to do better, the euro will go down. Just as when the global economy wasn't doing that well, the euro was going up. It could be a counterintuitive trade both ways. So anyways, for now, from a price point of view, it's 35 that's going to be the key breakdown level for the euro on the near term. And obviously, if it can break down to the 34s, the support here is going to be 33. And beyond that, it really moves out to the 130. So on a longer term basis, you have a potential here for 130 to the downside. To the top side, the euro is not a buy until and unless it takes out 140, which is granted a long shot from here, but it's also quite possible. I mean, we could be in a situation where we actually have the kind of slow grinding growth that doesn't allow U.S. rates to rise, but doesn't necessarily kill the nascent recovery in Europe, at which point European sovereign debt still looks pretty good and still on a relative basis attracts more capital flow, and the euro just simply pushes up on those dynamics. So any questions on the euro? That's kind of the story on the euro for now. We're waiting for a volatility breakout to 35 or 40 before you can get some kind of directional clues from it. Nicholas is asking me, how is the Japanese tax hike going to affect the yen movement? I think it's interesting because I think nobody's more aware of the negative impact of the tax hike than Japanese authorities. So, they've tried to offset this with fiscal spending. Time will tell whether this is going to be. I think usually, the whole thing is in the markets when everybody focuses on something, it usually never comes through. Yes, in the past, the tax hike has been mightily depressive for Japanese economy. But I think this time, because there's an offset with fiscal policy and because so many people are focusing on it, the depressive impact could be much less toxic to the Japanese economy than you would think. This is asking me if U.S. numbers are going to come in shockingly low like they did on Friday. What are the scenarios? Well, the scenario there is, like I said, dollar yen 100 becomes very, very clear possibility. And euro dollar moving through the 37 and, possibly I still think you would have to have significantly deteriorating U.S. fundamentals before the euro has a chance to come back up to 140. I think the euro 140 is an outside risk here. If you can see, this was a big short squeeze, but there is very little appetite for euro at 140 at this point. Certainly a tremendous amount of, I think, resistance from the European corporate sector. And if euro begins to trade at 138, you're going to have tremendous amount of pressure on the ECB to want to try to ease and knock it back down. I think the Europeans would love to see the euro 132, 130 for the rest of the year. And what's been driving euro higher has been capital flows. Investors basically buying up Italian and Spanish bonds in search of yield. But that story may be coming to an end. Dusty is asking me if the euro strength was due to the imbalances between the ECB and the Fed balance sheet. No, I think it's less of a problem. I think the central bank balance sheets are much less of an issue than people think they are. I really genuinely think it was investment flows. It was actual demand for European sovereign debt that drove demand for the euro. All right, well, let's take a look at cable next. Because I think cable is a really interesting story. And today, more so than any other time, this story is really starting to take shape. And the story in cable here, in my opinion, is peak growth, right? Peak growth. That's the central thesis of what's going on in UK. What I mean by that is look at this monster recovery, right? Look at very, very strong. Cable goes from 150 to basically 166 through the second half of the year. And the irony of the whole thing, this is a perfect example of like shoemakers' children going shoeless, right? I was in London June to July, basically. I was there for a week or two on business. And what shocked me was how booming the economy was in London. And I sort of just, since I really don't look at longer-term charts as much as I should, I really didn't put the two and two together and say to myself, this is potentially setting itself up for a secular bull move in the pound, which indeed it did. So, Q3, Q4 were very, very strong moves in cable because they showed continuously upside surprises in economic data. So what's different? What's happening now? What's different and what's really interesting is that in the last month, we've had not one, not two, not three, but four disappointing UK economic releases. We have potential for the fifth one coming up in retail sales this Friday. And while the data shows that the UK economy continues to expand, What's more interesting is that it's showing that it's expanding at a slower pace than the month prior and slower pace than the expectations. All of that is suggesting that there's perhaps maybe a little bit of a runaway train situation where the UK economy really got ahead of itself, and there should be some correction. So if there's some corrective action, it's quite reasonable to see the to see the cable trade itself down, certainly to 160. If you look at the daily chart, there's a clear topping pattern here. There's almost sort of a head and shoulders type of a pattern here with a 62 break leading all the way down to a potential 160 support level, basically 59.60 support level as it comes back down, to the downside. Taking a look at on let's say a super longer term chart, let's say monthly chart, we can see that there's also quite a lot of monthly resistance here at the 65 level, right? We've come there's been 3 or 4 times during the past 5 years where we've traded into 65s and then traded back down into the 45s, right? Happened here, ran all the way into the 70s, but then came back down. Happened here, came back down into the 50s, and then it happened here this time. So whether this is yet another topping out pattern will definitely be worth watching. But I think at this point, if you're a longer term trader, getting short here against the 66.50 stop, where you know your stop is relatively well defined, is a pretty interesting risk-reward ratio for a possible trade on a longer-term basis, perhaps even all the way down to 55, and maybe if you're super lucky, all the way down to 150. But I don't know if that's going to be that far. But certainly I think the first move down to 60 is quite reasonable, and then 55 is a possible corrective move. Cable is in a sell the rally mode right now. Somebody said that pound Aussie went down 330 pips today. It certainly did. It was one of the major trades today. In BK today, we were actually long Aussie. We just got out of the position. We just made money on the Aussie. And one of the trades we had on our board, but the only reason we didn't do this trade was because we don't do 2 simultaneous trades because the risk is short pound yen, which would have also been a very, very strong trade today. That would have worked. Those of you who are not in the BK, service, I'll see. Let me shoot you my link, and feel free to come visit our website. Okay, so I think cable is very much at a possible turning point to the downside. Certainly for now, I think if you're a long-term trader, you're safe with a 66.50 stop. By that I mean that you may have a lot of to and fro in the near term, but as long as that stop holds, the bias is to the downside, and there could be further downside pressure here. 60 as initial targets, 55 as a possible, given the fact that we're looking at the long-term chart and seeing that we're top of the trend line. Conversely, if things resume their torrid pace, if UK economy really begins to pick up steam again in Q1 and 66.50 is given, the next target is 70, obviously. But at this point, a break, I think, of 66.50 towards the 70 could really set up a much more powerful move, perhaps all the way out to 75. Why? And the reason for that would be that there'll become fresh pressure on the BOE to begin raising rates, perhaps even as early as the end of this year. And again, as I said, 2004 is going to be the year of rates. Will they or won't they? And if the market begins to feel that the Central Bank of UK will now going to go into a rate tightening cycle where rates are going to increase, that's going to be very, very positive pound. And pound could certainly trade its way all the way up to 75 as the year progresses. Dusty says that the pound is not bearish till you have a break of 58. I agree. It's not fully bearish till you have a break of 58. My point is that if you're speccing, if you're in the business of sort of picking tops, picking bottoms, this is a relatively intelligent spec in the sense that you have a very well defined risk. You see the momentum is on your side for right now, and I think a 66.50 break to the upside is a clear rejection of this of the turn. Well, on the other hand, if it doesn't break it, then the pressure for the downside will grow more and more. So that's the story with the pound as we go. Now, story with Aussie is very interesting because obviously Aussie is everybody's favorite punching bag, right? Aussie was just, if you look at 2013, the story of Aussie is a story of this waterfall decline, a retrace rally and a comeback to the test of the lows. What's interesting, what's happening over the last several days is nothing more than just a good old-fashioned short squeeze rally. So the short squeeze really got started on Friday because of the non-farm payrolls, because obviously positive, negative U.S. data was created a big short covering rally in the Aussie. But I think the squeeze continues today, and of course 91 is a key resistance level here in the Aussie. But the squeeze could turn into a much more painful move for the bears if Australian data begins to surprise to the upside. Now, I will grant you that is a long shot at best. Australia is certainly suffering from the slowdown in China, from a decline in its mineral sector, and from a slow but painful transition away from minerals and manufacturing towards more of a service retail competitive environment. In order for it to remain competitive, the Aussie really does need to remain here between 85 and 90. And certainly anywhere above 95, it really constrains Australia's ability to compete on a trade basis. And that's why the RBA really hates to see the currency so high up. But having said this, too, the RBA has not really, aside from job wanting, has not really been very aggressive in doing anything else to try to push the currency down. It did job on the currency down to the 85 level. But here is where, the support level here is really 88.50, right? And here's where the market seems to have made its stance. This 88.50 is going to be the very key level for Australian dollar, a make or break level, in my opinion, in 2014. So as long as we kind of hold above this 88.50, and the longer we hold about this, the longer we create a nice, strong base for it to counter rally. That would suggest that basically the Australian economy is not as bad as the market fears. Rates are not going to go down any further than they already have, and that the Aussie, for the time being, is stabilized. If on the other hand, we have negative data, and of course we have a big data test on Wednesday. We have the Australian employment data coming up on Wednesday. If we have continuously deteriorating data, let's say we have a couple of months of really bad employment data, that would create fresh pressure on the RBA, which is more than willing to do this, to lower rates further. And again, here is where the rate story becomes negative rather than positive. Remember, if 2014 is the story of positive rates for U.S., for UK, and perhaps for Europe, although not really, it's a story of negative rates for Australia. Well, certainly for New Zealand. I'll get to New Zealand in a second. It could be a story of negative rates. Basically, the story in Australia is very asymmetrical. No rate hikes at all on the upside, and possible rate cuts on the downside. Given that kind of scenario, it still pretty much becomes a sell the rally story. So this kind of a short squeeze that's happening now could be actually nothing more than just a great opportunity to get short the pair, around these levels, around 91, with a stock, let's say, at around 92, 93, right? Because we could have a very quick and certain curl. But a momentum sell on the Aussie, to me, a really, really strong sell on the Aussie, to me, does not occur, and we have to go to this on a much longer term charts, until we break this 88.50. If we break the 88.50, yes, this is or let's just say 88, because 80 is 88.30 is support. Then yes, we break the 88s, 85 really, really comes into view, and possibly even a test of 80, which hasn't been here since 2010, since we started to rebuild on an interest rate cycle. So basically, if the whole interest rate cycle up, now we could be in a long-term period, secular period of interest rate cycle down, with possibly 80 as a long-term target, and a sell the rally mode in the Aussie. Okay, a couple of questions here. Increased tensions in the Asian area, increased military spending by Japan, U.S. shifted military focus to Asian waters, and territories might be an outlier for movements in yen, Aussie, and dollar. Yes, It might. But, you know, and I certainly appreciate the geopolitical concerns because there are many of them. But the problem with sort of trading those ideas is that until and unless they happen, they're really a non-event, right? So if we get Japanese, Chinese fighter pilots having a dogfight over the islands, yeah, that's going to create tremendous amount of tension. Yes, that's very negative for risk aversion. Yes, that could mean dollar yen goes down. And here's the interesting thing. So why would a dollar yen go down significantly? Because at that point, the whole thesis moves away from economics and interest rates, and it becomes much more an issue of risk aversion. The first thing that's going to happen is if you have a dogfight between the Japanese and the Chinese fighter pilots, is the Nikkei is going to drop like 3 to 4%, maybe even 5%. That's going to create massive capital inflow back into the yen as everybody repatriates, and that's going to drive dollar yen back down. So you need to be aware of that dynamic just to prepare yourself if you do have sort of a shocking development like that. But I think barring that kind of a development, it's more of a concern than a reality for the year. You certainly have that, that on your plate, but it's completely untradeable from a long-term point of view because precisely it's not a long-term trend. It's one of those kind of things that can flare up, but not one of those kind of things that you can forecast well. Back burner, exactly, back burner thinking. So back to the Aussie. The Aussie definitely looks still like to be a sell the rally story, but really the strong sell here is the break of the 88 level. That would suggest further bad news for the Australian economy, further decline for the Australian dollar. For now, though, the fact that it's building a base on the near term, it looks to be still to be a short covering squeeze. And unless we get a series of negative economic data points that will put fresh downward pressure on it, the bottom line is, you think about this, it's kind of interesting. When you trade, everybody knows the story, right? We all know the story of Australia. We all know the story of slowdown China, so on and so forth, right? Most of the story is priced into the chart. So what will make the thing go down more? Not the story we already know. Only fresh, new negative news will make the story go down more. And if we don't get fresh negative news, then just by the laws of physics, that which doesn't go down begins to go back up, whatever the hell the laws of physics are, you begin to start to have a short squeeze. In other words, if you don't have enough reason to sell something, the speculators will make you buy it just to squeeze you out of it. So that's why there's a potential here for further short squeeze in the Aussie as we go forward. Okay, so what else? Let's take a look at the other COM dollars. We can take a look at let's take a look at Kiwi, and then finally I'll finish up with dollar CAD. So the story in the Kiwi is that this is supposed to be the most bullish of the COM dollar currencies, and it has certainly been trading much better than all the other COM dollars. Because the interesting story in New Zealand is that this may be New Zealand's turn for China growth. Because if you think what's happening is in China is basically moving itself as fast as it can away from growth by industrialization and manufacturing, much more towards growth by retail and services, right? They're trying to reconfigure the whole economy. Consumption is going to become a much bigger part of Chinese growth. So if consumption becomes a much bigger part of Chinese growth, then what you think about is what do Chinese consume? Chinese consume, of course, tremendous amount of new meat, protein, and milk. These are the two of the largest export factors of New Zealand. New Zealand is basically a food production exporter, whereas Australia is a mineral production exporter. So minerals are geared towards an industry. Food is geared towards the consumer. As the consumer gets wealthier and wants better, higher quality food, it's New Zealand that begins to benefit from this. And you can see that basically all the data points in New Zealand have become very, very positive and powerful to the upside. And that creates a natural move, in the Kiwi to the upside, especially given the fact that the RBNZ has telegraphed to the market that the bubble in its housing market, the fact that the housing market has become so overheated, requires it to raise interest rates this year. So the market has already priced in, 125 basis points of interest rate hikes for New Zealand, which means that the Kiwi certainly, once those interest rate hikes begin to come into fruition, and maintain well bid. It does remain range bound here at the upper end here between 80 and let's say 88. But if we do get sort of positive global growth and New Zealand rates beginning to rise, you will get, because this is a very small currency, very small market, but it's going to start to produce yield. You're going to get more and more speculative flows into the Kiwi, and the push here towards 90 is very possible. So the Kiwi itself could strengthen considerably on relatively small capital flows, only if and when it begins to raise rates and actually produce yield for investors. Conversely, if they don't, and the enthusiasm for the pair begins to wane, 80 is, of course, a very vulnerable point, but it really begins to drift all the way down to a 75 support. That's a pretty steep support, and I don't think it's going to break it this year unless the situation in New Zealand changes dramatically to the downside. But just simply a lack of yield could create a disappointment move all the way down to 80. Now, given the fact that people are bearish Australia, bullish New Zealand, the Aussie-Kiwi spread has gotten a tremendous amount of attention, and a lot of people are forecasting a move certainly to 105 and possibly all the way down to parity in the next year or so. Again, this is one of those kind of things to me where I would really want to have a show me factor. In other words, I would not want to short this right now on the assumption that it's going to fall. I really would like this pair to show me that it's going to start falling. And first and foremost, I'd like to see 107 broken. That would be a key bearish sign, which would put then 105 in play. And if 105 became broken, then the 100, then the parity level really becomes much closer in view. So I would not be a seller here until and unless I broke 107. I came into 106.65 or so. At that point, would create a fresh new lows and suggest that yes, this Aussie-Kiwi trade is very, very negative to the downside. Conversely, the top side right now, 110. That's what caps it. But if we get significantly stronger short covering in the Aussie, that is the idea that Australia does not cut rates any further, combined with the idea that New Zealand may not raise rates anytime soon, then you have a very serious prospect here of a move back through 110 and possibly all the way out to 115. So a recapture of 110 and a hold above 110 on a monthly basis would be very bullish for this pair and would signal that we may have made a bottom here well before the parity level, and then we could be trading back up to 115. Somebody wants me to take a look at Euro Kiwi. Let's take a look at Euro Kiwi. Euro Kiwi is basically an in-between chart. It really is not showing you much of a breakout or a breakdown either way. You could try to sell it below 160 if you think that, I think with the below 160, there's a reasonable chance that it can drift all the way into the 150s, above 170s, or really about 173, because that's the highs over here of this range. It does open up a prospect for a move towards the 180. But those are wide ranges for the time being. And I think it's hard to gauge. I mean, if you're a seller of Euro Kiwi, I wouldn't want to be a seller until it's gotten below 160, because up to now it's just basically trading bottom end of its range. All right, we don't have much time, so I want to just finish up with dollar CAD, which has been, I think, a very stealth and surprising trade this year. So this move that I think shocked so many people, the move through the 107s all the way through 109s, very, very interesting. And it basically, the story with CAD has been that the economy has been surprisingly soft, and this is really a trade on North America not having a great year this year. This is going to be a really interesting trade because if the U.S. economy does pick up steam, the Canadian economy is not going to diverge from the U.S. economy too far. So I think 110 which you can see on a longer-term basis, very strong resist level, will pretty much be the topping point for the Canadian economy. But if we start to see further deterioration and further decline, then there is potential here. If we can take out 110 on a closing basis that is closed above 110, it could be a move all the way out to 115 in dollar CAD, as both the whole North American sector kind of remains relatively depressed, and of course U.S. Trades up on an outperformance basis. I still think that this kind of a move, while strong and significant, runs into pretty strong stiff resistance at 110. And you'd have to have a very, very major recalibration of fundamentals for this thing to trade above 110 on a consistent basis. So those of you who like to trade tops and bottoms, this could be a potentially interesting sell zone somewhere around here. But the range now, of course, is 105, 110, whereas before it used to be 100, 105. We certainly moved into the new range in dollar CAD. So anyways, guys, any final questions before we finish up? I've kind of run out of my time. I hope you guys enjoyed this little look into the future. I'm happy to take a look at anything that we do at BK Forex. Please come visit us. And if you have any questions, please email me at contact@bkforex.com. Thanks again, and I thank you very much, and I will see you next month. Have a great day, guys. Bye-bye.